China just severed nearly $1 trillion in American investments overnight. No announcement, no negotiation, just silence. Wall Street is panicking, factories are freezing, and your retirement account might be next. This isn't a trade war anymore. This is financial warfare. There was a time when Chinese capital flowed freely into the United States, billions upon billions flooding into everything from entertainment giants in Hollywood to towering investment firms on Wall Street. American corporations grew accustomed to this river of money. They built entire strategies around it. They hired, expanded, and borrowed against it. But that river has now run dry. Without fanfare or formal declaration, the Chinese government has shut down virtually all outbound investment to the United States. No press conference, no diplomatic warning, just a quiet regulatory update buried in government documents that most people will never read, but whose consequences they will absolutely feel. And it's not just about numbers on a spreadsheet. This decision affects real jobs, real prices, and real lives. From the auto plants in Michigan to the tech startups in Silicon Valley, American businesses are waking up to a terrifying new reality. The money they were counting on is gone, and it's not coming back. This is not a temporary freeze. This is a calculated pivot, one that signals the beginning of a financial strategy far more sophisticated and far more dangerous than anything seen in recent decades. Let's start with the mechanics. On November 17, 2025, the State Administration of Foreign Exchange in China, the agency responsible for managing the country's currency flows, issued an internal directive. It wasn't broadcast on state television. It didn't make the front page of any major newspaper. But the order was clear: halt all outbound funding to American companies immediately. The reasoning? Rising geopolitical tensions and concerns over the safety of Chinese assets abroad. In other words, Beijing no longer trusts Washington to play fair. This directive appeared in regulatory filings reviewed by international agencies and was later confirmed by Reuters. But by the time the story broke, the damage was already underway. The Ministry of Commerce had quietly revised its outbound investment guidelines, labeling certain nations, including the United States, as hostile, and declaring that any non-essential capital transfers would be suspended indefinitely. The numbers tell the story. According to research from the Rhodium Group, Chinese investment into the U.S. had already been collapsing for years. Back in 2016, at the height of economic cooperation, that figure sat at roughly $46 billion. By 2018, it had started to decline sharply. By 2023, it had shrunk to just $2.3 billion, a drop of more than 95%. Now, with this latest freeze, that number has effectively hit zero. Professor Jia Dajing, an economist at Peking University and a close observer of China's financial strategy, describes this not as an emotional reaction, but as a deliberate tactical maneuver. According to him, Beijing is trying to apply financial pressure on American firms without triggering an outright confrontation. It's economic suffocation, dressed up as regulatory compliance. And what makes this even more significant is not just what China has stopped doing, it's what it started doing instead. Capital doesn't just disappear, it moves. And right now, Chinese money is moving away from the United States at an accelerating pace, and toward new partners who are more than willing to accept it. In 2025 alone, China offloaded $14 billion worth of U.S. Treasury bonds. That's the largest single-year sell-off since 2016, bringing China's total holdings down to $689 billion. To put that in perspective, China was once the largest foreign holder of American debt. Now it's steadily reducing its exposure and signaling to the world that it no longer sees U.S. bonds as the safest bet. But it's not just about bonds. Chinese state-owned banks have also begun refusing to process dollar-based transactions with American financial institutions. New compliance rules issued by the People's Bank of China have effectively frozen dollar flows at the institutional level, making it harder, and in some cases impossible, for U.S. companies to do business with Chinese counterparts. Former U.S. Commerce Secretary Gina Raimondo warned publicly that these moves are quietly eroding Washington's leverage. For decades, the United States has used its control over the global financial system as a tool of power. Sanctions, embargoes, and asset freezes all depend on the fact that most international transactions flow through American banks and are settled in U.S. dollars. But if China can build alternative systems that don't rely on dollars or American institutions, then those tools lose their bite. And that's exactly what's happening. China is deepening ties with Riyadh, Moscow, and even parts of Europe. Trade agreements are being renegotiated, payment systems are being redesigned, and slowly but surely, the scaffolding of a post-dollar financial architecture is being built. Traditional measures like tariffs and export controls simply can't counter this kind of strategic repositioning. They're too slow, too reactive, and too dependent on cooperation that no longer exists. The financial gap between the United States and China isn't just growing, it may already be unbridgeable. The exodus isn't just Chinese. Here's where things get even more concerning. China isn't the only country pulling money out of the United States. It's just the most visible. In 2025, total foreign investment into the U.S. fell by 22%. And while Chinese funds were the most conspicuously absent, they weren't alone in heading for the exits. Norway's massive sovereign wealth fund, one of the largest and most conservative investment vehicles on the planet, withdrew $7.1 billion from American tech companies. The reason? Unpredictable regulations and an increasingly unstable policy environment. Japan's Government Pension Investment Fund, which manages more money than almost any other pension system in the world, cut its exposure to U.S. commercial real estate by 30%. This came after Moody's downgraded several regional American banks, raising red flags about the stability of the sector. These aren't speculative hedge funds making risky bets. These are cautious, institutional investors, the kind that prioritize stability above all else, and they're walking away. By the end of 2026, over $4.1 trillion in U.S. corporate debt will come due. That's an enormous amount of money that companies need to refinance. Normally, they'd turn to foreign investors to help roll over that debt. But with fewer foreign buyers in the market, American firms are being forced to look inward, and that's driving up costs significantly. Domestic lenders are stepping in, but they're charging much higher interest rates. Companies that once borrowed at 3 or 4% are now paying 8, 9, even 11% or more. For businesses already operating on thin margins, that kind of increase can be the difference between survival and bankruptcy. The junk bond explosion. When traditional sources of capital dry up, companies get desperate. And desperation leads to risky decisions. In 2025, the issuance of high-yield bonds, commonly known as junk bonds, hit $430 billion. That's a 38% increase from the year before. These are bonds issued by companies with lower credit ratings, meaning there's a higher risk they won't be able to pay back what they owe. Investors demand higher returns to compensate for that risk, which is why average yields on junk bonds jumped from 5.2% in 2022 to 9.6% in 2025. Take the case of Hartwell Tech, a Boston-based technology firm that had been in advanced negotiations for a $180 million funding round backed by Chinese investors. The deal was all but finalized. Then, overnight, it collapsed. The funding disappeared without explanation. Hartwell scrambled to stay afloat. They eventually secured emergency financing from Apollo Global Management, one of the largest private equity firms in the world. But the terms were brutal, an 11.3% interest rate, with the company forced to pledge both its intellectual property and its real estate holdings as collateral. That's not growth capital. That's survival capital. And Hartwell is far from alone. According to analysts at Fitch Ratings, 1 in 5 mid-sized American companies is now at serious risk of what's called rollover failure, the inability to refinance existing debt when it comes due. If that happens, these companies face a stark choice: sell off assets, lay off workers, or declare bankruptcy. Private credit funds, which had been stepping in to fill the gap left by traditional banks, are now tightening their own terms. They're demanding more collateral, charging higher fees, and taking fewer risks. The result is a vicious cycle. Companies need money to grow, but the only money available is so expensive that it undermines growth entirely. Reshoring hits a wall. For years, American politicians from both parties have talked about bringing manufacturing back home. Reshoring became a rallying cry, a promise to rebuild the industrial base, create jobs, and reduce dependence on foreign supply chains. In 2025, President Donald Trump signed an executive order designed to accelerate that process. It expanded tax credits for companies willing to invest in domestic production, particularly in industries deemed critical to national security. But here's the problem. Those plans depended heavily on foreign capital. According to the National Association of Manufacturers, 62% of companies that had announced plans to expand domestically are now facing significant financing shortfalls. Why? Because the foreign partners they were counting on, many of them Chinese or Taiwanese, are no longer participating. Projects that were announced with great fanfare in 2024 are now stalled or canceled. An $8 billion battery manufacturing plant in Michigan, dead. A $3.1 billion robotics facility in Nevada, on indefinite hold. Even Intel's massive $20 billion semiconductor project in Ohio, which was supposed to be a symbol of America's renewed commitment to chip independence, has paused its second phase due to funding challenges. Economist Eswar Prasad, speaking to Bloomberg, put it bluntly. Without access to diverse sources of capital, these projects risk becoming nothing more than symbolic gestures, rather than transformative economic achievements. The ambition to bring supply chains home is running headfirst into the reality of unavailable money. And honestly, that gap is growing wider every day. The price consumers pay. All of this might sound a bit abstract. Corporate debt, investment flows, manufacturing projects. But honestly, the consequences are already showing up in ways that everyday Americans just can't ignore. U.S. tariffs implemented in 2025 now cover more than $500 billion worth of Chinese imports, up from $370 billion just 5 years earlier. Average tariff rates are hovering around 22%, according to the Peterson Institute for International Economics. Those tariffs don't just disappear. They get passed along. Electronics cost more. Home appliances cost more. Car parts cost more. In fact, prices for household appliances alone rose 16.7% year over year in 2025. Analysts estimate that the average American household spent nearly $2,000 more in 2025 than they would have in a tariff-free environment. That's not a tax you see on your paycheck, but it's a tax nonetheless, hidden in the price of everything you buy. Meanwhile, corporate earnings are slowing. Growth among S&P 500 companies decelerated sharply in the fourth quarter of 2025, dropping to just 1.2%, down from 4.5% the previous quarter. Executives are caught in a bind. Do they absorb the rising costs and hurt their bottom line, or do they pass them on to consumers and risk killing demand? With wages stagnating and inflation still running above 3.6%, raising prices is a gamble. But so is eating the cost. Uncertainty reaches crisis levels. There's a metric that economists watch pretty closely when they want to measure how confused and anxious businesses are about the future. It's called the Economic Policy Uncertainty Index, and it tracks things like policy changes, regulatory shifts, and, conflicting signals from government. In the final quarter of 2025, that index hit levels not seen since the 2008 financial crisis. and actually exceeded the volatility recorded during the early months of the COVID-19 pandemic. Think about that for a second. The current level of uncertainty in the U.S. economy is worse than the chaos of a global health emergency or the collapse of the housing market. Why? Because businesses just don't know what's coming next. Tight monetary policy, unpredictable government spending, erratic trade rules. All of it is converging at once, just as the global economy is trying to recover. The Conference Board, which tracks CEO sentiment, reported that its confidence index plunged to 37 in December 2025, the lowest reading since mid-2020. Nearly 70% of executives cited unclear policy direction as a major obstacle to long-term planning. Analysts at Bank of America noted something striking. The slowdown in capital investment isn't being driven primarily by high costs. It's being driven by confusion. Companies simply don't know what the rules will be 6 months from now, so they're holding back. And investors are reacting accordingly. In just 3 months, over $120 billion flowed out of U.S. equity exchange-traded funds. That's not a rotation. That's a retreat. Experts are warning that this isn't a temporary dip. It's a sign of eroding trust. And if U.S. allies start to recalibrate their confidence in American markets, Washington could lose something even more valuable than money: the ability to set global standards. Allies are hedging their bets. While the United States grapples with internal instability, other countries are, quietly building bridges elsewhere. In November 2025, Germany's chemical giant BASF announced a $10 billion expansion of its operations in China. The deal was sealed following a state visit by Chancellor Friedrich Merz and came with a joint energy technology agreement. BASF isn't abandoning Europe or the United States, but it's making very clear where it sees future growth. France, meanwhile, signed a multi-year liquefied natural gas deal with China, denominated entirely in yuan. No dollars involved. French Finance Minister Bruno Le Maire described it as a pragmatic move aimed at securing energy stability. But honestly, the symbolism is hard to miss. European investment in Chinese industrial zones rose 19% in the fourth quarter of 2025. When asked why, European executives pointed to one thing: policy stability. They know what the rules are in China. They know what to expect. In the United States, they don't. Even Saudi Arabia, one of America's oldest and most strategically important partners in the Middle East, is diversifying. Riyadh recently redirected $27 billion away from U.S. Treasuries and into an artificial intelligence development fund, a joint venture with China and Singapore. Kenneth Rogoff, former chief economist at the International Monetary Fund, explained it this way: "The United States is not losing influence entirely, but its gravitational pull is weakening. Allies aren't rebelling, they're seeking stability. And Beijing isn't demanding allegiance. It's offering predictable rules, backed by a carefully calculated long-term strategy. That's the real danger. China doesn't need to convince the world to abandon the United States. It just needs to offer a viable alternative. And right now, that's exactly what it's doing." China's long game. The investment freeze may be just the opening move in a much larger strategy, one designed to redirect global capital flows, weaken U.S. markets, and strengthen China's regional dominance. The China Securities Regulatory Commission fast-tracked 38 foreign initial public offerings in Shanghai and Shenzhen during the fourth quarter of 2025, a 52% increase from the previous quarter. At the same time, China's sovereign wealth fund quietly increased its exposure to debt issued by ASEAN countries by $194 billion. But perhaps the most strategically significant development is the rollout of the digital yuan. It's now linked to SWIFT Lite settlement networks operating across 13 countries, enabling cross-border trade without ever touching the US dollar. Harold Wang, an analyst at HSBC, explained the strategy succinctly. "The goal isn't to replace the dollar overnight. It's to make the dollar one option among many instead of the only option. That shift may sound subtle, but its implications are massive. For decades, the dominance of the US dollar has given Washington unparalleled power in global finance. Sanctions work because most countries need dollars to trade. Embargoes work because most banks clear transactions through New York. But if China succeeds in building parallel systems that work just as well without the dollar, then that power evaporates. And here's the thing, this transition won't happen with drama or declarations. It will happen quietly, through inertia. One trade deal at a time, one digital transaction at a time, one quiet reallocation of capital at a time. By the time Wall Street realizes what's happened, the money may have already moved. What comes next? So where does this leave us? The freeze on Chinese investment into the United States is not an isolated incident. It's part of a broader recalibration of global finance, one that has been building for years and is now accelerating. American companies are facing higher borrowing costs, reduced access to capital, and an increasingly unpredictable policy environment. Consumers are paying more for goods, even as wages stagnate. Allies are diversifying away from US markets in search of stability. And China is methodically building the infrastructure for a world in which the dollar is no longer indispensable. This is not a crisis that will resolve itself with a single policy change or a diplomatic breakthrough. It's a structural shift, and it's happening right now. The real question is not whether China's strategy will work. The question is whether the United States has a strategy of its own. Because if the answer is no, then what we're witnessing isn't just a pause in investment. It's the beginning of a fundamental reordering of the global financial system. And the consequences of that will echo for generations. China didn't declare war. It didn't impose sanctions. It just stopped paying. And in doing so, it may have fired the first shot in a financial conflict that will reshape the world. The question now isn't whether this will hurt the US economy. It's how much and for how long. Because when the money stops flowing, everything else eventually follows.